Imagine this. You work all month. Your paycheck arrives. Bills get paid. A little money is left over, so you do the responsible thing. You save it. Maybe it sits in your checking account. Maybe it sits in a traditional savings account you've had for years. The money is safe. You can see the balance. Nothing seems wrong. But here's the uncomfortable question. What if your money is safe, but barely working for you? Imagine you have $10,000 sitting in an account paying just 1% APY. After 1 year, you'd earn roughly $100 in interest before taxes. Now imagine that same $10,000 in a hypothetical account paying 4% APY. The difference would be roughly $300 more in interest over a year. Same $10,000. Same person. Same basic goal, saving money. The difference is simply where the cash is sitting. And that raises a bigger question. Why would two banks pay dramatically different amounts for essentially the same thing? Your deposit? That's where the story gets interesting. Because in 2026, the question isn't simply whether you're saving money. It's whether your savings account is keeping up with the opportunities available to you. The money you don't notice losing. For millions of Americans, the biggest problem isn't reckless spending. It's financial inertia. You opened a bank account years ago. Your paycheck goes there. Your mortgage or rent comes out of it. Your debit card is connected to it. Your bills are automated. Everything works. So why change it? That's exactly why checking your savings APY can feel so unimportant. There isn't a dramatic moment when you lose money. No warning appears on your screen. Your balance doesn't suddenly fall. Instead, something much quieter happens. You earn less interest than you might have earned somewhere else. And because the money is sitting there anyway, the opportunity cost can become almost invisible. But before you decide that every high-yield savings account is automatically, why are banks willing to pay different rates in the first place? Why banks pay different rates. Think of a bank like a business that needs raw material. For a bank, deposits are one important source of funding. Customers put money into checking and savings accounts. The bank can use its funding to support activities such as making loans and managing its balance sheet. And this creates competition. One bank might already have plenty of deposits. Another bank may want to attract more customers. An online bank may have a different cost structure than a traditional branch-heavy bank. So banks don't necessarily have the same reason to pay you the same rate. And when the economic environment changes, the value of deposits can change too. That's part of what makes 2026 interesting. As of July 2026, the Federal Reserve says the federal funds target range has been maintained at 3.50% to 3.75% since the beginning of the year. That doesn't mean your savings account should automatically pay a particular rate. It doesn't. But it does help explain why interest rates remain an important part of the banking landscape. And that's where one little acronym becomes extremely important. AP. What AP really means. APY stands for Annual Percentage Yield. In simple terms, it's designed to show how much you could earn from an account over a year, taking the effect of compounding into account under the stated assumptions. Think of APY as the number that helps you compare savings accounts. Suppose, hypothetically, you have $5,000. At 1% APY, that's about $50 over a year before taxes. At 4% APY, that's about $200. Now increase the balance to $25,000. At 1%, roughly $250. At 4%, roughly $1,000. And at $50,000? At 1%, roughly $500. At 4%, roughly $2,000. These are simplified hypothetical illustrations, not promises of actual account earnings. But they reveal something important. The larger the cash balance, the more important the rate. And APY isn't just a marketing number you should glance at. Federal consumer protection rules require deposit institutions to disclose information such as APY, interest rates, minimum balance requirements, and fees, helping consumers compare accounts. So the number is useful, but only if you understand what sits behind it. Like why high-yield savings got attention again. High-yield savings accounts aren't magic accounts. They're generally savings accounts designed to offer a relatively competitive yield compared with lower-paying alternatives. And competition matters. Online banks can compete for deposits without operating the same physical branch network as traditional banks. Banks may also change their rates as economic conditions and their own funding needs change. That's why the phrase high yield should never mean permanently high. A savings APY can change. And this is one of the most important details people overlook. A high APY you see today isn't necessarily the APY you'll receive next year. In fact, consumer disclosures for variable rate accounts specifically recognize that the interest rate and APY may change. So if you move money into a higher yield account, you're not locking in that number forever. You're choosing an account under its current terms. And that brings us to the catch. The highest number isn't automatically the best account. Some accounts may have minimum balance requirements. Some may charge fees. Some promotional offers may only last for a limited period. Some may have eligibility requirements. And some accounts may be less convenient for someone who needs frequent access to their cash. That's why the real question isn't, what's the highest APY I can find? It's, what am I actually getting for that APY? Read the account disclosures. Check whether the rate is variable. Look at fees. Check minimum balances. Look at withdrawal and transfer terms. And most importantly, understand what type of financial product you're actually opening. Because high yield describes a rate, it doesn't automatically tell you everything about the product. The safety question. Now comes the question almost every saver should ask. Is my money protected? For deposits at an FDIC-insured bank, FDIC deposit insurance generally covers checking accounts, savings accounts, money market deposit accounts, and CDs. The standard coverage amount is $250,000 per depositor, per insured bank, per ownership category. But there's a crucial distinction. FDIC insurance is not a blanket guarantee for every financial product that happens to be offered by a financial company. Stocks, bonds, mutual funds, and treasury securities, for example, are not FDIC insured. So don't simply see a familiar financial brand and assume everything connected to it has identical protections. Verify the institution. Verify the product. Verify the insurance status. That's not paranoia. That's basic financial housekeeping. The $10,000 test. Now let's return to our original example. Two people. Both have $10,000. Person A leaves the money in a hypothetical account paying 1%. Person B puts the money in a hypothetical savings account paying 4%. After 1 year, before taxes and assuming the rates remained unchanged, Person A earns about $100. Person B earns about $400. The difference? $300. But here's the part one wants you to remember. The lesson isn't, move your money immediately. The lesson is, know what your money is earning. Because you can't make an intelligent decision about your cash if you don't even know the current APY. And there are several ways people get this wrong. 10 common mistakes. Number 1, never checking your APY. You might know your account balance down to the penny, but have no idea what interest rate you're receiving. Number 2, confusing interest rate with APY. They're related, but APY is designed to reflect the effect of compounding and provide a standardized comparison. Number 3, chasing the biggest advertised number. A huge rate may come with conditions, limits, or a promotional period. Number 4, ignoring fees. A higher yield means much less if account costs eat away at the benefit. Number 5, sacrificing access to your emergency cash. Your emergency fund has a job beyond earning interest. You may need it quickly. Number 6, assuming the APY is permanent. Savings rates can change. Number 7, forgetting taxes. Interest income can create tax consequences, so your headline earnings aren't necessarily what you keep. Number 8, putting every dollar into one place. Cash has different jobs. Your everyday spending money may need different features from your emergency savings. Number 9, trusting the advertisement instead of the disclosure. The advertisement gets your attention. The account terms tell you what you're actually getting. Number 10, assuming every high-yield product has identical protections. It doesn't. Understand whether you're dealing with a bank deposit, another type of financial product, and whether FDIC insurance applies. Who should consider a high-yield savings account? A high-yield savings account may make sense for someone who has cash they want to keep relatively accessible while earning more interest than their current account provides. That could include emergency savings, money set aside for a major purchase, or cash that isn't needed for everyday transactions. But that doesn't mean everyone should move everything. If you need constant transaction access, a checking account may be more convenient. If you know you won't need money for a specific period, a CD could be worth comparing. And some people may also compare cash alternatives, such as treasury bills. Each option has different trade-offs involving liquidity, rates, There is no universal winner. The right question is, what job does this money need to perform? Biggest lesson. Here's what makes this entire story so interesting. The person who saves money is already doing something responsible. They're working. They're earning. They're resisting unnecessary spending. They're building a cushion for the future. But financial mistakes aren't always about losing money. Sometimes they're about failing to notice what your money could have been earning. That $10,000 doesn't need to become an investment portfolio. It doesn't need to be exposed to the stock market. It doesn't need to be locked away for years. Sometimes the first step is much simpler. Just look at the account where your cash is sitting. Look at the APY. Look at the fees. Look at the terms. Look at the insurance. And ask one simple question. Is this account still making sense for the job this money needs to do? Because in 2026, your money doesn't have to be reckless to be inefficient. It can be sitting safely in a bank account and still be working harder than it currently is. So before you close this video, check your current savings APY. Do you actually know what your money is earning? And if you check today, tell me in the comments. What APY is your bank paying you in 2026?